Hi, my name is Beuker and I did my presentation on accounting fraud. Accounting scandals within corporations happen in the United States today, even though the number of practices are designed to prevent them from happening. Accounting scandals occur when executives of a company intentionally report their financial statements incorrectly. Incorrect reporting usually involves misusing funds, overstating revenues, understating expenses, which affect net income. Overstating the value of a corporate assets or understating liabilities are also forms of accounting scandals. The Sarbanes-Oxley Act of 2002 was passed by U.S. Congress in order to try to protect investors from the possibility of fraudulent activities by corporations. The SOX Act required strict changes in order to improve the accuracy of corporate financial statements when they are disclosed to investors. SOX was passed in early 2000s in an attempt to prevent future accounting scandals, since there were a lot of scandals at the time. These include Enron, Tyco, and WorldCom. Why is accounting fraud important? I'm an accounting major here at App, so I find this topic very interesting. It is directly related to my major and my future job, since I plan to become an accountant. My intended future job requires ethical behavior in order to prevent scandals. Researching previous unethical behavior will increase my knowledge of what not to do as an accountant. It is important because it deals with unethical behavior while dealing with money, including other people's money. It is always important to find a way to reduce the number of scandals, even though it may be impossible to completely stop these scandals altogether. Here are some legal issues involving accounting fraud. Toshiba is most recently in 2015. They overstated profits by nearly $2 billion over 7 years. Beuker Incorporated was in 2012. They made up revenues and avoided booking certain expenses to meet the analysis estimates. Since they made up revenues, they also overstated net income, because net income deals with revenues and expenses. Their stock price rose as a result of their reported net income, and then the executives at the company sold more than $2 million in their company stock at a higher price than what it should be. Health South, which actually my mom used to work for them, not as an accountant or anything, didn't have to do with scandal at all. She's a dietitian, but in 2004 the company's earnings were inflated by about $1.4 billion. The most famous or infamous case involving accounting fraud is Enron, which happened in 2001. They hid debt off. They put it off their balance sheet, which they found loopholes on ways to do that, but it was very deceiving to the stock holders, because it appeared that they had absolutely no debt when they were really millions of dollars in debt. WorldCom was in 2002. They inflated assets by as much as $11 billion. With the accounting scandal at WorldCom, this led to 30,000 jobs being lost and $180 billion in losses for investors. Tyco was in 2012. The CEO and the CFO stole $150 million within the company and overstated the company income by 500 million. Bernie Madoff is also a rather infamous accounting scandal which happened in 2008. They tricked investors out of $64.8 billion through a Ponzi scheme, which was the largest Ponzi scheme ever. As I mentioned earlier, the Sarbanes-Oxley Act of 2002, it was passed by the U.S. Congress. It established the Public Company Accounting Oversight Board. This was to provide independent oversight of public accounting audit firms, since along with the company that is participating in the accounting fraud, there's also an audit firm that is supposed to audit the company, and they need to make sure that the company is following the rules, which obviously they need to report if they're not following the rules. So the Sarbanes-Oxley Act of 2002 included information and new rules regarding whistleblowers, which are employees within a company that is participating in accounting fraud. These employees who report accounting fraud and unethical behavior are protected under the Sarbanes-Oxley Act of 2002. So why do we need this act? It was developed in result of a loss of public confidence, confidence in financial reporting, the accounting, and also the accounting profession in general, because obviously they were not doing their jobs correctly. And it also is a result of public confidence in the SEC's willingness to enforce security laws, which obviously if a company is able to get away with this, the SEC isn't completely doing what they're supposed to be doing. The SOX Act was also to prevent a loss of money from stockholders who, in these cases, they were affected hugely. They were misled, and it cost them money. Also, accounting scandals cost employees money, because like in the Enron scandal, the company went bankrupt, which their employees not only lost their job, but lost a lot of money in future retirement accounts that they had through Enron. There are two types of focuses when developing the SOX Act of 2002. There's an implied focus, which is to restore the public's confidence in U.S. corporations. Obviously, as I said earlier, the public lost confidence in corporations. So there's also express focus. So in conclusion, the Sarbanes-Oxley Act 2002 was enacted as a result of numerous accounting scandals and unethical behavior, and there's still a lot of work to be done, but overall the Sarbanes Act of 2002 has improved corporate America because it has restored confidence in the public. It has helped restore confidence in corporate America. Thank you.